Hey there everyone, Dave Keller here with Market Misbehavior, and in today's video we're going to talk about how I use the RRG, the relative rotation graphs. This is a fantastic visualization, allows you to look at different sectors, different asset classes, different stocks or industries, pretty much whatever you want, but allows you to visualize them in sort of a moving scatter plot. Really, when we talk about sector rotation, we're talking about how stocks and styles and themes come in and out of favor and how assets essentially rotate between different areas of the market, growth versus value, offense versus defense, etc., etc. And by using the RRG charts, we can actually visualize that rotation, and because of the way they're calculated, things rotate in kind of a clockwise motion, and so it really makes sense visually, and I think it can tell you some fantastic stories to understand how assets and how flows are shifting underneath the hood of the markets. Before we get to the RRG, how I use them, and some great recent examples, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions, and when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koyfin. Koyfin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koyfin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koyfin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so let's look at the RRG, but before we do that, I want to show you some of the charts that I look at every day, and some of the charts that I think help illustrate why the relative rotation graph is such a fantastic sort of high-level way of understanding rotation, and particularly leadership rotation, leadership themes in the markets. Here's one of my favorite charts that I've reviewed for years. This is what I call my offense versus defense chart. And I created this chart years ago after talking with one of my Fidelity predecessors, Bill Doan. He ran the Fidelity technical research team in the 1970s. And before he passed away, I was so fortunate to be able to meet with him a little bit, learn about his process, and ask him questions about some fantastic periods in market history like the 1970s and 1980s, where I was either not born yet or certainly not paying attention to the markets yet. And he was an active investor during that period. So it was a great opportunity. And one of the things he told me about the chart room in the 1970s at Fidelity is that they had this chart, which was called the offense versus defense. Now, it used a series of indicators and indexes which were no longer available when I was running the team in the late 2000s, but it did inspire me to really think about that rotation of assets. And so I started using ETFs and essentially focused in on the XLY and the XLP. So this is looking at the consumer discretionary sector versus the consumer staples sector. So when this line's going up, offense is outperforming defense. When this line is going down, defense is outperforming offense. Now, it's helpful to just understand which sector is doing better than the other, but it's also good as a broader indication of risk and whether institutional investors are rotating more to the offensive side of the ledger with consumer discretionary. Think luxury purchases you don't need but you kind of want, versus consumer staples, more defensive, more stable companies that are relatively immune to economic forces, because basically we always need toilet paper, beverages, cleaning products, personal products, right? It's not like you upgrade those things necessarily when things are good. They're just things you need, not necessarily things you actively really want. And so as a result, this ratio has served me really well, particularly over the last 6 months, recognizing the strength with offense over defense into mid-January, and then essentially a period of market weakness with defense outperforming offense since mid-January. Now, the problem with that top ratio, the XLY and the XLP, is that they're cap weighted. And so I have an equal weighted version, which kind of minimizes the impact of like Amazon and Tesla and those kind of big mega cap growth names. But you can see both of these are actually trending downwards pretty consistently. Now, these aren't the only ratios that I follow. Within my Market Misbehavior live chart list, and I'll have a link in the description to that list of charts if you want to review them on the Stock Charts platform. But basically, I have a series of sector relative performance charts that I review every day as well. This one looks at the three growth sectors: technology, communication services, consumer discretionary. You can see that technology and communication services have been pretty consistently underperforming in 2025. Communication services, the lone outlier, which has been stronger than the other two, but really starting to weaken here in the last 6 weeks. Then we have the four value sectors: industrials, financials, materials, and energy. These are what we call cyclical sectors. These are companies that tend to do well when the economy is strengthening, when investors are optimistic. You tend to see early leadership from some of these names. And indeed, you're seeing industrials, for example, make a new 3-month high here today on a relative basis. And as a reminder, all of these are relative charts. So it's the industrial sector, the XLY, relative to the SPY. So if it's going up, it's outperforming. If it's going down, it's underperforming. Then we have the four defensive sectors: utilities, healthcare, consumer staples, and real estate. Note how all four of these are pretty consistently outperforming in 2025. Now, the problem is I've just shown you 4 charts, each with 3 or 4 different series on there. It's a lot to digest, and how do you really differentiate them between one another? This is what I learned from Julius de Kempener years ago when he was at a brokerage in the Netherlands, and I was at Bloomberg and then Fidelity. And I remember, learning, being introduced to his work. I met Julius at a conference and completely fell in love with the way that this visualization is constructed, because what it does is it takes all of those charts, a lot of other content I haven't shown you in those previous charts, and just summarizes them in one visualization. And I'm a huge fan of data visualization tools that allow you to draw conclusions more easily, more efficiently, more effectively. And I would argue that the RRG kind of does all 3 for me. So just to orient you to this visualization, if you've not used it before, there are 4 quadrants, and it's driven by basically the rotation of these different sectors. And right now I'm showing the 11 S&P 500 sectors, all relative to the S&P 500. So imagine that the S&P 500 is kind of at the crosshairs there right in the middle. The x-axis, right, from left to right, is driven by relative strength. So if it's further to the right, that means it's outperforming. Think of those previous charts, like the defensive sectors where the relative strength lines were sloping up. That means it's going to be rotating to the right side of the chart, the visualization here. Things are underperforming. If the relative lines are going down, like technology, you're going to find it moving further to the left because it's starting to underperform. The y-axis is basically the momentum. So if we're outperforming, but the trend starts to slow down, we're not outperforming by as much, the slope is starting to deteriorate, you'll see things rotate from the leading quadrant down to the weakening quadrant. As the performance starts to really deteriorate and the relative performance starts to go down to a certain degree, it rotates to the lagging quadrant, implying that this sector is underperforming the S&P. When we're underperforming, the momentum is just starting to turn up a little bit, we get into the improving quadrant, and we continue this clockwise motion of outperforming, slowing down, kind of weakening, and then lagging, and then improving, and then leading, and we kind of rotate as a cyclical pattern. And by looking at this one visualization, I can gauge how 11 sectors or whatever other group of things I want to pop in, I can see how they're all rotating around that benchmark in the middle. So this is the main one that I look at almost every day. This is the weekly data because I'm a little more of a position trader. I'm a little more of a medium-term, long-term investor. So I'm not trying to day trade these sectors. I'm really trying to more understand the shifting tides, the cyclical relationships about how assets are flowing from offense to defense, from growth to value, from different themes to one another. And so I think this is a good starting point. Now on stock charts, there's a fantastic capability, which is at the top. You can click on this little preview chart of the S&P 500. You can put the RRG in motion. So going back to like the February peak here, we can see going into, let's see, this is January. You can see the dates up here in the upper left. You know, through the end of January, now into early February, Note how you have offensive sectors like technology, communication services, consumer discretionary, all in the leading quadrant. In the lagging quadrant, we have all the value sectors, or most of them, and certainly all the defensive sectors with materials, real estate, healthcare, really underperforming. But look what happens going into the February peak, and then going into March, and then going into April. And note how all of the offensive sectors, the growth sectors like communication services, consumer discretionary, technology rotating southwest, and all of the value and defensive sectors rotating northeast. So when we talk about the great rotation of 2025, the leadership rotation that we've observed from the beginning of the year now to mid-April, this visualization, I think, brilliantly shows and demonstrates that rotation from offense to defense, from value, or from growth to value, that is. Now, what's really cool about the visualization as well is we can highlight particular sectors. So for example, I could just take technology on its own. It keeps the other ones in there that kind of grayed out, so I can really focus on technology. So if you want to think about one sector, look at technology and look at how it really outperformed in the fourth quarter. This is now October, November, December, staying in the improving quadrant, finally getting into the leading quadrant at the end of January. But by early March, we're already down into the lagging quadrant. And at this point, easy to say technology is the worst performer out of this bundle of stocks, right? Because it's furthest to the left. It's not really turning higher. This is a sector that is underperforming the rest of the market. So how do we actually use this? I mean, I think in terms of understanding where the rotation is happening is so meaningful. So generally speaking, I like to think about sectors that are in the leading quadrant. These are the kind of things I probably want to own, right? I probably want to have exposure to these sectors if I do own stocks, because these are the ones that are really outperforming. These are the ones that are really getting it done. When things get down to the weakening quadrant, these are areas where I generally want to be lightening up because the rotation, again, for the sector is starting to come off. And this is not to say there couldn't be individual stocks within those sectors that are outliers, that are doing something different. Totally fair. But as a sector allocation, right, thinking about my general approach to adding risk or subtracting risk from a particular sector, going into the weakening quadrant implies I probably want to start to lighten up. When things get down into the lagging quadrant, these are sectors I probably don't want exposure to because they're underperforming the market, right? And so, I was taught if you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. That's why relative strength is such an important part of my process. So when things are in the lagging quadrant, I want to sort of lighten up or avoid them. And then when things start to improve and get into the improving quadrant, that means the performance is probably not quite there yet, but it's starting to show signs of improvement. So that's sort of your proving ground. That's where you can start to look for opportunities. So again, at any given moment, I have ideas of which sectors are improving, which sectors are struggling, and just think about the fact that the flows are actually making these rotations happening, right? Where investors are putting their assets and their own buy and sell decisions are manifesting into this beautiful visualization. Another really cool trick, remember that first chart I showed you about offense versus defense? We can take the two offense and defense sectors. So I've highlighted both consumer discretionary and consumer staples. I've done that so that we can actually see how the two of these are related one to another. Sorry about that. So one of the other things I like to do is look at offense versus defense. If you remember that first chart that I showed you in the video, looking at consumer discretionary versus consumer staples, well, I can select multiple sectors. So now I'm looking at the XLY and the XLP, and using that same sort of markets in motion technique, I can see how, here in January, offense over defense, not even close, right? Offense doing quite well, defense doing quite poorly. Look at what happens going into the peak in February. All of a sudden, consumer discretionary offense rotating into the weakening quadrant. Consumer staples very near to getting into the improving quadrant. And from there, even with the noisy craziness that we've had in April, it's very clear that defense is outperforming offense. So again, instead of showing one just linear representation of that ratio, I can actually look at them in relationship to all the other sectors and really understand how we're seeing those bets rotate. So as long as defense looks like this and offense looks like this, I don't know how bullish I want to be about broader market conditions, because the leadership rotation is telling me defense and value over offense and growth. Now, all of this has been using weekly data, and that's where I usually start again because of my time frame. But you have a shorter time frame, you can go with shorter time frames for sure, right? So in the upper right corner under period, I'm going to use the daily time frame. I usually don't go much lower than that, but if you're more of a day trader or swing trader, you may want to look at hourly data or 30-minute data. You're welcome to do it. I rarely get down into that sort of granular look at, moment-to-moment trading within the day, but the capabilities are there, and it certainly gives you an opportunity to understand some of the rotation that happens between the trading days through the course of a trading week, for example. But using the daily data, here we're going back to the sort of market peak end of January. As we get into the February peak, I'm going to highlight these three growth sectors. So here's communication services, here's consumer discretionary, and there's technology, right? We can see as we get into the February market peak, communication services the strongest but rotating down, technology getting into the leading quadrant, consumer discretionary in the lagging quadrant. Now, again, this is using shorter term data. So these are not broader cyclical rotations, but more tactical shifts between one and the other. And you can see during this downtrend that we've experienced from February into March and then eventually into April, a number of times where some of these offensive sectors, these growth sectors, have actually rotated in and out of the leading quadrant. Now, again, I would argue those are counter trend moves within a longer period of deterioration, but it can help you identify some of the shorter term swings that we identify within sort of the larger trend. Other thing I will show you is look at the defensive sector. So this is the XLP and the XLU. Here we're looking at the market peak going into February. And what's interesting is by mid-February, look at how consumer staples and utilities are both in the leading quadrant, which is a bit of a head scratcher if the market's threatening new all-time highs. Now, on a closing basis, we made a high here in late February. From there, look at how the defensive sectors of consumer discretionary and utilities on the daily chart were way off to the right. As we pull back a little bit here, we saw this brief period where it looks like technology was going to recover. This is sort of like end of March, beginning of April, right around April Fool's Day. But note here this cyclical rotation with utilities and consumer staples that happens all to the right side of the y-axis, right? So they're making a cyclical turn, but it's all happening to the right of the y-axis. That is one of those more profitable, more compelling signals that I've seen after years of following this visualization. When things make a cyclical rotation to the right of the y-axis, think about what that means. That means they're outperforming the whole time, right? But the fact that they're over to the right half of the visualization means on a relative basis, they're outperforming the benchmark because the benchmark is at the 0 point. But because of that cyclical rotation, that just means the relative strength is kind of having upswings and downswings. So these little tweaky moves, but overall, the general trend of outperformance is good. And when things rotate from leading to weakening, never make it past the zero line and then get back in the leading quadrant. That's when I tend to find fantastic opportunities to reinitiate and identify new leadership. So going into the April low, we see those defensive sectors really starting to improve yet again. And that's where we're at here. I mean, the two strongest sectors on the daily RRG, consumer staples and utilities, two of the most defensive of the 11 S&P sectors. So that is how I use the relative rotation graphs. For me, it's all about rotation. It's all about leadership. It's all about flows between offense and defense, growth and value as different themes come in and out of favor. We can use ratio analysis, what I call my offense and defense chart, looking at some of those relative performance charts of the sectors, and I review those every day. But then as quickly as I can, I get to the RRG, the relative rotation graph, And I think Julius DeKemeter did a fantastic job creating a visualization that summarizes that rotation in a visual representation that really follows that clockwise pattern that I think we mentally assume that sectors actually do. It's so refreshing to actually incorporate the data into this visualization and see that indeed, if you calculate it right, the rotation is very clear. So for now, in mid-April of 2025, I'm still seeing defense over offense. I'm still seeing value over growth. And until we see some dramatic changes to the RRG, I'm inclined to assume that those trends are in place. That's it for today. What do you think of the RRG? Have they helped you analyze the markets? How do you use them in ways that I didn't show? Make sure you drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts.